Good day, everyone. It's finally Thursday, the big day we've all been waiting for. A combination of technicals, earnings of weaker sales from big companies, and a jump in long-term interest rates drove the stock market lower today and set the tone for the rest of the trading day. Several key reports came out today. The government reports were slightly better than expected, but the private sector came out with disappointing news. I personally believe the move today is mostly technical, but Wall Street needs to always have a fundamental reason for anything that happens in the markets. Starting with the fundamentals, the Department of Labor reported earlier that weekly jobless claims in the US fell to their lowest level since January of 2008, dropping by 15,000 to 320,000. This data beat analysts' expectations and initially set the tone for a stronger opening. The Department of Labor also revealed that U.S. Consumer Price Index rose 0.2% in July from June and 2% from July of last year. That's in line with analysts' forecasts. U.S. industrial production came in flat in July, according to the Federal Reserve, which was primarily the expectations on the street. The private sector, we saw Walmart cut its estimates for annual sales and profit, warning that cautious shoppers are spending less. Walmart is the biggest retailer in the US and has strong influence on the retail sector as well as the broad market. I want to make a quick comment. Over 30% of our subscribers are from different parts of the world, so this is why I'm explaining how big of a store chain Walmart really is. The news followed revenue forecasts from Cisco Systems that were weaker than Wall Street's expectations. Technically, the broad market had a breakdown with a gap below the 1680 level. This is the exact level we've been watching during last week. The next level of support comes in at around the 1640 level to the downside. What's also interesting is the fact that we've been sitting on the bottom of the range without much of a pullback during the trading day. This is indicative of strong selling pressure, especially after an opening drop that strong. We had ample warning from several sectors that this was going to happen, so I can't say I'm too surprised. The breakdown is broad across most subsectors, which shows consistency. For example, the financial sector, which has been weak the last several sessions, broke down as well. We hit our target level of 20, and I'm anticipating more breakdown towards the 19.5 level if we continue straight down. Looking at the retail sector, which in my opinion should appear weaker considering the news out of Wall Street today, it looks like we're headed down to the 78 level. This is where the sector shows strong support to the downside. Finally, the semiconductors are also looking substantially weaker, with a very large size gap between yesterday's close and today's open. It takes a lot of momentum to create a gap that big, especially in an ETF. So I wouldn't be surprised if the tech sector and especially the semiconductor sector took us down to another level near the 36.5 level. The bond market continued its decline down to the range as we anticipated it would. And remember what I always say about the bond market. It overreacts on a consistent basis, so we have to take profits quicker here than most other markets. The base of the support area is around the mid to low 114. And right now we are in the low 115s, and we went through the high 114s very quickly and turned around. If tomorrow we have follow through in the stock market, we may see a quick slide down to the low 114 area, which is our target. If you trade ETFs, let me know and I will email you a few to track this market. On a pure fundamental level, the sell-off today is very likely due to the excellent jobless claim numbers we saw this morning, which is likely causing traders to sell bonds in anticipation of a higher likelihood of tapering announcement next month. Crude oil rose today due to growing concerns regarding the civil unrest in Egypt. Fear that violence may disrupt the flow of oil through the Suez Canal pushed prices up. Clashes between the supporters of Egypt, ousted President Mohamed Morsi, and Egyptian security forces sent oil rising. There's fears that the tensions may spread and involve the country's oil-rich neighbors as well. Although we rallied, we didn't see the type of volatility or momentum I would expect to see with this type of information. And it sadly confirms my analysis that based on this information, which came to light several weeks back, we cannot sustain a price above the high 108 level at this time. So I'm not bearish just yet, but I do believe we will start to see weakness in crude shortly. Gold and silver are both rallying today. The speculation on the street is that civil unrest in Egypt is causing higher gold prices. I would expect to see this more in oil, but we got it in gold, so we can't complain. Remember, at times of war or civil unrest is the time the public takes money out of stocks and bonds and puts them into gold and silver. And this time is no different. I'm very glad we're seeing this rally because it gives me a better price to sell gold ultimately. I'm very bearish long term, but would love to see the 1400 to 1430 level because there's a lot of resistance and I could sell at a higher price. If you trade silver, the breakout in the silver market is extremely correlated to the gold market. The breakout looks a bit better, and I believe the market can hit the 25 level within the next few sessions if we continue to slide in the US equity market and if the Egypt situation persists. And I'm fairly sure it's not going away anytime soon. My biggest surprise is the fact that we aren't seeing this type of rally in the energy market. But we had clues when the production report came out a few days ago. We didn't see any rally there either, so be careful if you're long crude at these levels. Also remember, many of you trade ETFs, and there's an ETF for every market that I go through. If you're interested in a particular one, just send me a quick email and I'll gladly send you the best one for the market you're interested in. Lastly, the US dollar is coming down again as anticipated. Yesterday, I gave you a pivot that would have made a great risk stop and entry, and many traders entered short yesterday as a result. If you follow this newsletter, you know that the 80.5 is my target, and it seems like we're headed there. Look out for minor support near the high 80 area, but if we clear that area, we are home free. So the next question is, where do we go from here? The stock market across most sectors is bearish, and there's nothing really holding it back right now. Buyers who entered near the high are getting nervous, and we may see more selling coming in tomorrow. Remember, Friday is either a slow day or a very volatile day, and rarely anything in between. So be prepared to short the rallies if you're day trading. There's a few setups for tomorrow you should look at. There's a 4x4 to the downside. The ticker symbol is QDEL. Sell on a sell stop 10 cents below today's low. And if filled, place a buy stop 15 cents above today's high. There's also a tail gap to the upside on Budweiser, the beer company. The ticker symbol is BUD, and you should enter long 10 cents above today's high, and if filled, place a sell stop 15 cents below today's low. That's it for today. Be careful tomorrow. We're expecting more volatility, especially to the downside. I will touch base with you in the morning. Have a great night, everyone.